Hello, class. All right, hopefully you've watched the introduction, you've watched the How to Be a Millionaire, you've listened to the stock project, and you are ready to pick your stock that you're going to be tracking. But now we start actually into the meat of things, and we're going to start with chapter one in the book. And this is learning objective one is by the forms of business organizations and the uses of accounting information. So, what is the job of an accounting, and what is our end product? And the end product really is information. And so, what we're doing is we're collecting information, we're classifying information, we're organizing it, and we're then creating different financial statements, which we'll talk about. The different financial statements are related to each other and they come from the accounting system. So a lot of you are science majors, and your job again is possibly to record information and then put it into a usable format to achieve your purpose. Maybe you're trying to determine how something will have an impact on something, on a process or something. And so you structure the data to be able to record that in a format and pick out information that you need. And then you will put it into this program, and hopefully your program will provide you with this report. And so that's what we're doing. We're collecting information, and you can do it in a number of different ways. We use an accounting system. Normally, it's a computer system. Even you, as an individual, could use something called Quicken, which is what I use, and it's an accounting system, but you don't really have to know the ins and outs of accounting to be able to provide the information. You have QuickBooks if you have a small company, and I think Oracle is coming out with a product as well. So you input information into the computer system, and then that creates your financial statements. So, business organization. Now, we are going to be tracking public companies, and public companies are companies that are sold on some of the exchanges, and these companies are controlled by the Securities and Exchange Commission, but they have to do their accounting according to what's called Generally Accepted Accounting Principles, GAAP. And that is determined by the Financial Accounting Standards Boards. But the SEC is the one that monitors the public markets and sets the rules and regulations. If you want to be on the stock exchange, then you have to, one, comply with GAAP. You have to provide quarterly financial statements. You have to provide yearly financial statements. You have to release information in such a way. Every public company is what's called a corporation and a C corporation. There's a difference between a C corporation and S corporation. So if you decide to go into your business, then you have to determine what structure, all right? The easiest structure here is just sole proprietorship, which means I'm going to go out and I'm going to work and people are going to pay me and I'm going to put all this on my personal tax return. So there's what's called a Schedule C, and Schedule C is where I'm going to be putting this information as far as all my revenue or the money people pay me, and then all expenses that I incur or that I pay for to earn this revenue. And that's the simplest, but it's also the most dangerous because you're personally liable. And if somebody sues you, then they can come after your personal assets. The partnership is like a sole proprietorship, but you have partners, all right, and you're all in this together. And the negative part of the partnership is that if when your partner does something, then you can be sued and they can come after your assets for something your partner does. Now, both of those can be cured by what's called a limited liability company. So, in other words, it is a shell and provides liability so that anyone that sues you can only come after the assets that are actually in the business name or in the partnership name. And then there's the corporation. And again, these are C corporations, and all public companies are C corporations. There are lots of advantages to C corporations. These are companies like Amazon and Microsoft, uh, Kroger, Home Depot, Lowe's, Publix, etc. And so a corporation basically sells interest in a corporation by stock. So if you're a sole proprietorship, you own 100% just by the nature of the sole proprietorship. If you have a limited liability company, you do have shares. And if you own all of it, you own 100%. Corporations sell stock, and they sell it. And then once it's on the open market, it's on the stock exchange, and that's really is between individuals. The company just is responsible for doing well and possibly paying dividends. Okay. But a corporation can go to millions of people, so they can raise large amounts of money. There's no personal liability. So, in other words, if a corporation is sued, they're not coming after me as a shareholder. My only liability is whatever I could lose in the stock that I own. But I'm not going to have to pay the corporation's bills. So that's limited liability. It's easier to raise funds. And you can transfer ownership. If you're a sole proprietorship, well, you are the sole proprietorship. Partnership involves lots, have to sell things, and there are legal issues. But for stock, I can just call my broker or online and go sell the stock, and they sell it. If you're going to start your own business, then you need to talk to a tax attorney or an accountant, because each form of business has its advantages and disadvantages. And depending upon what your long-term goals are, you need to determine what entity. If nothing else, you should become an LLC, limited liability company. Is fairly easy. You do have to follow some rules, but you can shield your personal assets from liability. So again, a corporation, the shareholders are the owners of the corporation. If I have 10% of the shares, I own 10% of the company. So the shareholders own the corporation. So in choosing the organization form for your outdoor guide service, you should consider the pros and cons of each, identify each of the following organizational characteristics with the organizational form or forms with which it is associated. Easy to raise fund, that's got to be a corporation. Simple to establish, sole proprietorship or partnership. No personal legal liability, that's a corporation. Tax advantages, sole proprietorship or partnership. Again, if you're a corporation, you're actually an entity. So the entity pays taxes. Unless you're an S corporation, and then you pay taxes on your personal taxes. So you would again do a Schedule C, and you would get a proration of the revenue and the expenses and other items that, like dividends or capital gains, etc. Those would be different, but they will go on your personal taxes. A corporation is an entity, so they get taxed. And then when they pay dividends, which are money back to the shareholders have to pay taxes on those dividends, although at a reduced rate, depending upon the type of dividend. So tax advantages would again be sole proprietorship or partnership. Easier to transfer ownership, definitely a corporation. Again, all I have to do is get online and buy or sell. All right. So financial information is really divided into external and internal. And external really is financial information, and it's guided by generally accepted accounting principles for public corporations. Internal users use financial or management accounting, and there aren't really rules for that. In that case, all you're trying to do is to determine something that will help you in your business. For instance, I want to see if I change a supplier, if I use a different product, and if maybe that product was of higher quality and allowed me to reduce my labor costs, what is the impact on my product? And that is just an answer you're looking for. And so that would be in internal users like marketing managers, production supervisors, etc. So, is cash sufficient to pay dividends for our shareholders? What price should we charge for our newest smartphone model? These are types of analysis that you're doing to solve internal questions. External users, of course, would be investors, creditors, the government, because you have to pay taxes, or you have to pay taxes, so they want to know how much you're making. And tax accounting is different from financial accounting. So this is for external users, right? Is Apple earning satisfactory income? How does Apple compare in size and profitability with Samsung? Will Apple be able to pay its debts as they come due? So that is the type of information. Again, our products accountants is information to help people make informed decisions about whether to invest in a company through either bonds or stocks. Of course, this day data analytics is huge. There's just mounds and mounds and tons of data that's available. So now it's to the point of, okay, we're collecting all this data. How do we use it effectively? And so there are different levels. There's like description, a financial statement, what happened. There's a diagnostic. Why did it happen? Why did this, sales go up, sales go down? And then there's predictive, which is, okay, what do we think is going to happen based on the data? And so a lot of that is going on today. And the prescription would be, what should we do about it? Okay. So you can see that we're going from hindsight to insight to foresight. We're not there yet, but hopefully we'll continue to get better. Financial reporting, people rely on this. You have in 2001, there were a number of different scandals from public companies. And what this does is that it says here Health South. I bought Health South at some point. I had done some research and decided that they were a growing company. They were doing well. I had a past business association with them, so I bought Health South stock. 3 months later, it came out that 5 CFOs had basically engaged in financial fraud. And so what I thought were earnings no longer were valid earnings. Their earnings were a lot lower because they basically cooked the books, so to speak. And so my $5,000 investment went down to $3,000, which I never recovered. So Congress passed what's called the Sarbanes-Oxley Act. That's SOX, and it just regulates auditors, which is a public company that goes in and looks at the company's books and says they do comply with GAAP, generally accepted accounting principles. So there are rules, of course, if the CEO and the CFO can go to prison if they have fraudulent financial statements, even if they didn't know anything about solving an ethical dilemma, recognize an ethical situation and the ethical issues involved, identify and analyze, and then identify the alternatives. Types of business activities, and coincidentally, your statement of cash flow is broken down into these different activities as well. So you have financing activities. Okay, I need money to run the business. How am I going to get it? Am I going to use my personal savings? Am I going to borrow from the bank? Am I going to borrow from other people? Am I going to sell shares in the company so that I give up some ownership, but I get money to help the business? So that's, again, financing activities involved in raising money from outside sources, borrowing money or issuing stock. Of course, paying dividends is part of the financing activity because you're paying back to the shareholders money that you've made for the corporation. Investing activities means you're purchasing assets. You might be purchasing investments, okay? But you're purchasing assets that are used in the business. So the next time you go into a place, look at the kind of assets that they are using for their business. If you go to Chick-fil-A, what do they have? Well, they have land, of course, they have a building, they have ovens, they have counter space, they have computers, they have tables, chairs, soda machines, uh, deep fryers, refrigerators, storage space, etc. These are assets that they use in their business to generate income. Um, Home Depot, of course, has buildings, they have shelves, they have storage space, they have uh, computer systems, they have self-checkout stands, etc. Movie theater, they've got this big movie theater. They've got, place computer systems again. They've got places where you can buy a ticket, where you can show your little phone and uh, show the ticket. You get popcorn, so they've got counter space. A lot of theaters now have pretty good food. They've upscaled their food service, so they've got uh, food service facilities as well. So anyway, you go into these businesses. These are the assets they use. They're investing in their business. They're investing in assets that they need. Also, intangible assets, which are big here in Nashville, copyrights. And if you don't think that's important, um, Katy Perry sold her music catalog for $300 million. That seems pretty important to me. And then finally, you have operating activity. Here's what we do. Okay. So Chick-fil-A, what do? They make food, they sell food. What does Home Depot do? They buy stuff and then they sell it to you. So these are the type of activities. So what do they need to run those businesses? Well, again, they have the property, plant, and equipment, which we've discussed, but they have supply costs. So they have the chicken, they have the buns, they have the lettuce and the tomatoes, etc. They have staff, salaries, which is usually the biggest expense for a business. These are expenses. They've got electricity, they've got insurance. So these are all the things they need to operate their business, okay? And depreciation, which is what we'll talk about later, but basically an asset that lasts more than a year, which, a building would last more than a year, an automobile would last more than a year, a deep fryer, hopefully. Somehow you have to recognize that as you use that, the value decreases over time. And you recognize that through what's called depreciation. So over time, that asset you bought, which you bought and you put on your books for what you paid for it, you're going to do a contra account to go, okay, I paid $10,000 for it, but each year I'm going to say, well, it's not worth 10,000. Now it's only worth eight, then six, then four, then two, then zero. All right. So again, expenses or cost of assets consumed or service used in the process of generating revenue. Home Depot would have what's called cost of goods sold. So every time they sell something from their inventory, that goes from an inventory, which is an asset, to a cost of goods sold. What are our product? Information. So we're going to produce multiple income statements, but we have four basic statements. We have the income statement, which is income. Did you make money? If so, how much? And then in fact, this is the order in which we produce these. We're going to have something called a trial balance. And a trial balance is just going to be a list of all your different accounts. Say a checking account. So that would be your cash account. And so in that account, in your checking account, you have deposits, you have payments, but end of the month, you have an ending balance, which is the beginning balance of the next month. So that's an account. A company will have an account based on the type of business they're in. So Chick-fil-A would probably have a food account, and they may subdivide that into other categories: chicken, condiments, Cokes, Pepsis, whatever. Okay, so that they know how much they're spending on those different categories. And so whenever, that's called an expense account. So every time you expense something, you add it to that. At the end of the month, you have a balance in all these accounts. And that trial balance is just going to list all these different balances. And you're going to use that information to prepare these different financial statements. Income statement: did you make money? Retained earnings. All right, if you made money, how much did you keep? Or did you give some back to the shareholders, which are called dividends? So if I made $10,000 and I gave $2,000 back to the shareholders, my retained earnings is going to be $8,000. And then the balance sheet are your assets, liabilities, and equity. Let's say that you have one asset, it's a house, and you paid, it's $100,000. So that's your asset. You've got a house worth $100,000. And then you've got a liability. You borrowed $80,000. All right. So you've got, this is a little ahead, but the accounting statement and balance sheet is assets are equal to liabilities plus equity, or owner's equity, or shareholder equity. They're all the same thing. In your case, you've got a $100,000 asset. It's equal to an $80,000 mortgage plus $20,000 you put down, which is your equity. If you bought a $100,000 house and you borrowed $70,000 and you put $30,000 down, then you would have $100,000 is equal to a $70,000 mortgage plus $30,000 equity. Your balance sheet, again, every transaction affects your balance sheet. When you pay an expense, when you pay dividends, when you buy personal property, when you borrow money, when you issue stock, every one of those is going to affect one or more sides of the balance sheet. And then the statement of cash flows is, how did you obtain cash? And then what did you do with it? So those are our four financial statements. Again, the trial balance and the accounts, the purpose of accounting is to collect information, classify this information, and present the information so users can understand the information. It's collected when a financial transaction takes place. You bought something, you sold something, you used something. The general ledger is a group of accounts that are used by a company. And so again, Home Depot wouldn't necessarily have a food account. They would have different merchandising accounts, but Chick-fil-A wouldn't necessarily have merchandising accounts, but they would have food accounts. An account is just a list of all transactions for that account. Just as a checking account is just a list of all your transactions. So every time you deposit something, you add to your bank account. Every time you pay something, you subtract from your bank account. But at the end of the day, you have the pluses and minuses. So you started with a balance, you add your deposits, you subtract your checks and your transfers, etc. And you have an ending balance. That's how it works in every type of account. And a trial balance is a list of all accounts and their balances on a specific date. And that's what we're going to use to prepare financial statements. So the retained earnings statement uses the results of the income statement. So we always produce the income statement first. And what you're going to have is a trial balance. And the trial balance, the accounts are usually listed by assets or usually begin with a 1. So if you have 5 digits, then cash may be 10,000. And accounts receivable would be 10,001. You have 4 digits, it would be 1,000, 1,001. Expenses or liabilities are usually begin with a 2. Equity is a 3. Revenue 4, expenses 5. And you see how important, how that works when we do the trial balance. The trial balance, you're going to use every account once, and you're going to use really start from the bottom. You're going to have the revenue expenses, and that's going to create your income. And then you're going to take your beginning retained earning balance, which if you just started would be zero because you have no retained earnings. And you're going to add your net income, subtract your dividend, and then that's going to be your ending retained earnings balance. And so you're going to use that figure, and then you're going to go up and you're going to start listing your liabilities under the assets, or assets under the asset side, liabilities and equity. And so your retained earnings that you come up with are going to go to your balance sheet, and then you're just going to simply list the other assets. Now, assets equal liabilities plus equity means that if your assets are $100,000, then your liabilities and equity have to be $100,000 as well, or something's wrong. So the income statement is always prepared first, then the statement of retained earnings, and then the balance sheet. The cash flow statement is prepared last, and really you're going to use the balance sheet to do that. So there are a variety of users and users of financial information match each of these to the following terms. Data analytics would be marketing managers, financial directors. Internal uses of financial information management, of course. Element of Sarbanes-Oxley. So, often employs both software and statistics to draw inferences. External users of financial information, they want to look at different stocks and decide which one they want to invest in. And then steps in resolving ethical dilemmas, investors, and labor unions. All right, so that's it for the initial overview of accounting. Just to sum it up again, all public companies are C corporations, which is a separate entity. The shareholders own the company. They elect the board of directors, and then the board of directors appoint or hire the president and everyone else. Our product is financial statements, and we're going to accumulate all this data. We're going to put every transaction into an accounting system, which is usually a computer system. And then the computer system is automatically going to be able to produce these financial statements. But we're going to do it and just show you basically how it's done. So that is going to be your first project, technically your second.